here I am. I'm going to produce another video here. Obviously, you're watching it right now. If you like this video, tell me you like it. Show me, by using a like and subscribing. If the engagement is there and people actually find value in my videos, I will certainly publish more of these. I just need to know that I'm not wasting my time by doing that. So again, if you like it, share it, let me know, and I'll keep going, and I'll get deeper and deeper as we go along with these videos. Today, I want to focus on a video that many of you asked for, which is cycles on a shorter time frame. So the last video covered Bitcoin from a 4-year cycle perspective, the bull and bear phase over multiple years, of course. But that cycle is great for hodlers and investors. Doesn't do much for traders, of course. So myself, I'm a trader of over 20 or almost 25 years. I've been focusing on cycles for over a decade. I focus on cycles in the gold markets and equity markets, crude oil, and of course Bitcoin. And from a trading perspective, I like to use what we call the daily cycle. It's a cycle that we measure on a chart using the daily candles, and then each asset class has varying levels of time frames. In the equity markets, for example, we see the cycle alternate every 40 days, so oscillates every 40 days from one low to the next. And you can see on this chart here, these green arrows represent a cycle low. It's a low in price, but also it's really a low over a given cycle time frame. So in Bitcoin, we like to measure the cycle over a 60 to 65 day time period. But it's not absolute. It's not something where we say every 60 or every 65 days we must see a low. Cycles are kind of a look back. Okay, they're not necessarily something that's going to predict the future. They're looking back, and they are basically reflecting sentiment that we have in the asset class. So in Bitcoin, we see sentiment on the shorter time frame from a trading perspective. It oscillates on average, again, 60 to 65 days, give or take, okay, and it varies. In the bull trend, we actually find that the oscillation is fairly consistent. It's closer to that 60 to 65 day range than it's not. Some of these cycles, like 50 here, were kind of outside of that range, but you'll see in the bear market, it actually alternates and fluctuates quite a bit more, so it makes it a little more unpredictable. But in the bull trend, which I'm showing you here over 2017, we have a number of what we call right translated bull cycles. And before I get into this right now, let me show you something here which I think will help. So here we're showing a sequence of shorter time frame cycles over a longer cycle. So cycles, first of all, are found everywhere. Okay, our entire lives are intertwined with cycles. We probably don't realize it so much, but the universe is very fractal in nature and very repetitive over a cycle sort of period. The weather and seasons and so much about our lives revolves around the cyclical nature. And asset classes and financial markets are, of course, no different, because they are made up of essentially humans trading an asset, exchanging the value in the asset itself. And because humans are involved, and because humans and the universe is very cyclical in nature, we find these repetitive cyclical price patterns in asset classes pop up time after time after time. And you can see the cyclical nature going back, even like over 100 years in the equity markets, for example. And then in Bitcoin, you see these cyclical nature occur every 60 to 65 days, and then every 4 years as well. And this chart here kind of shows you what we're talking about. You've got this longer time frame, which is smoothed out, of course, and it's smooth because, say, this may represent the 4-year cycle. And then you've got bull periods and bear periods, and within that you've got this oscillating ebb and flow manner of a 60-day cycle that goes round and up. So as the 4-year cycle is an uptrend, so let's use the last 4-year cycle as an example. For 3 years it went up. So for the most part, for those 3 years, you had this rising 60-day cycle pattern. So each 60 days was oscillating from a high to a low, from a high to a low. But overall, each of the low points in that pattern were higher than the previous ones. Not every single time, but for the most part. So if I flip back to this 2017 chart of Bitcoin, you see that each of these lows are higher. This one here was a sort of a double bottom, but each one, every single time, was higher. And same for the tops. Look at the tops. Every single one was higher. So if I go back to this chart here, this in the bull trend allows you to see that if you understand where you stand in the 4-year cycle, it helps you understand how the 60-day cycle is most likely going to move. And then if we go back and I show you the bear period of 2018. Now every low was not lower, but it certainly was not higher, but every high was lower. Okay, so if you understand again where you are, so here's the bear trend. If you understand where you are in the 4-year cycle, it's going to let you and help you understand how to trade the 60-day cycle in a bear trend. So in the bear trend, you've got lower highs, lower lows. And in the bull trend, you've got higher lows and higher highs. So knowing that, let's just step into this a little bit more and give you a little more detail into how I trade cycles and what they're really about. So let's look at this bull market trend of sort of 2017 mostly. The green arrow represents a cycle low. The number below that is the amount of days between the one green arrow and the next green arrow. So the amount of trading days between the one cycle low and the next cycle low. And they're not perfectly consistent, and we're not trying to make these perfectly consistent. And I'm not trying to tell you right now that this is some miracle strategy that if implemented or if you followed is going to make you rich. It's just not. Nothing is anything remotely close to that in trading. This is a tool that if used correctly and if studied deeply can provide a good and solid edge. But you still need to employ proper trade management, proper risk management, of course. You have to obviously get a good and solid handle on the emotional side of your trading. So for example, if you're buying in on one of these cycle lows and you're riding this higher, are you getting out at a top? Are you taking profit? And then, are you getting out at your stop point as well, especially in a bear market low, for example. So those fundamental trading strategies need to be front and center to be successful in any strategy you pick. So cycles, like any other strategy, like Elliott Wave or any other tool in the tool bag, trader's tool bag, is a means for helping us identify trends, helping us identify trade setups, and potential trades that offer a very good risk-reward ratio to you. So that being said, as I covered, the green arrow represents the cycle lows, and the red arrow represents the cycle peak. So within a 60-day cycle, or a daily cycle, let's call it a daily cycle, you have obviously two lows that represent the start and the end of the cycle, and then somewhere in between those two green arrows you have a price high. And that number on top represents the amount of trading days we had from the last cycle low to the peak. And there's one thing you'll notice about this, if you take a good quick look at this. Every one of these red candles, besides this one, the number, so 38, let's use this cycle as an example. From this green arrow to this cycle low, we had 69 trading days. The peak occurred on day 38. The midpoint of this cycle, if you take half of 69, you end up with, let's say, 35. 35 is the midpoint for this cycle, somewhere around here. If you take 63 and divide it by 2, and you end up with 31.5, somewhere around here, for example. Okay, this one here, 50 is 25. So this one occurred, and these aren't perfect lines, of course, just trying to illustrate here. 61, you've got 30, so somewhere around here. And I think you're starting to get the point. Let me make one more. 58, around about 29. Okay, so what I'm showing you here is that this peak occurred on the right side of the midpoint. This one occurred on the right side. This one occurred on the right side. This one on the right side, and so on. And so this one here. In an uptrend, the peak occurs to the right of the cycle midpoint. So simple point to make here if something goes up for more trading days and it goes down, it stands to reason that the overall trend for that cycle will be higher. So every time you have a situation where the midpoint is past the high point for the cycle was past the midpoint, you get what we call a right translated cycle. So it's translated to the right because it peaked to the right of the midpoint. And every time you get that, most of the time, maybe 95% of the time, the low occurs higher than the previous low. The low occurs, here it is here again, occurs much higher than the last one, and so on. In this case here, where it peaked only on day 15, this was a profit-taking cycle from this massive cycle here. But even then, because you're in a bull market, you didn't get a price low. It actually just double bottomed. So this is interesting, 35 trading days moving lower from the peak, but yet it didn't make a new low. Why? Because we're in a bull trend at this point. The 4-year cycle is moving higher. So even though you had a left translated cycle here, you still had this bull market moving higher. So last year, or sorry, now 2017, when this was occurring, it was easier, well, it was easy for me at least, and there's plenty of these posts on Twitter that I made, but it was easy for me to get in around these dips, because in a bull market, in an uptrend, you want to be buying the dips. Anytime price comes down to touch the lower Bollinger Band in the time frame for a cycle low, there's a good chance it's going to reverse up quickly in almost like a V-shaped manner. Okay, so in an uptrend, when you know you're in an uptrend in the 4-year cycle, what you're doing is you're looking for these drops into the time frame around day 50 and beyond, but most preferably day 60 or so, like these here. And you're looking for a reversal after a significant sell-off. So if you look at the RSI 5, for example, it's showing us in each one of these dips a drop below the 30 line. Okay, that's a cue to get ready for a new cycle. And as you see evidence of a new cycle form, you can get in long, and you can ride that past the midpoint in almost every case. In this case here, you probably would have been stopped out pretty short, or you could, you may have held on, but in general, each of these cycles give you an opportunity to ride them higher because you know you're in a bull trend. So you can go up to day 35, day 38, and then once you see the market peak above the Bollinger Bands during these tops, you're taking off leverage, you're taking off, you're taking profit. You may be getting out altogether. You're certainly scaling out, and that's for sure. And then as you see a breakdown in price, okay, as you see a what's called a swing high or breakdown below the 10-day rising moving average, you can take all profit and then repeat again on the next cycle. So this is just giving you a overview of how the 60-day cycle alternates, or oscillates, I should say, in a larger uptrend. So we know that the trend is up in this case, so we're playing these cycle lows and we're taking profit near the top. It's not a perfect science, okay, but it's giving us the edge, and it's allowing us to get in with a little more leverage perhaps, or a little more risk at these lower points, okay, and then allowing us to take profit on the way up. Now I'm going to quickly flip over to the bear scenario. So when we peaked here on this parabolic top, I think for a lot of people it should have been fairly obvious by this point, being 20x up over just over a year, that the market was in a parabolic move. But even so, if you're trading cycles and you're peaking above these areas here, you're taking profit, as I said before, and then you're riding this down, and then you're most likely, I'm going to give you an example of what happened to me specifically, but so you're out at this point here, you've banked a really nice profit at that point, and then you're looking for the market to come down, and then this is around, I think, day 65. This was a cycle, what I thought was a cycle low at the time, and then getting in long here. So getting in long around the 3rd or 4th day of that cycle, it peaked up here, dropped back down, and this point here is when you actually are fooled by the change in trend, and you have to be fooled by a change in trend, even though this parabolic move told me that there's a good chance that that bull market might be over, but we don't know. Okay, so at this point here, we're looking at potentially a new cycle. You're long at this point, and then it reverses. But again, this is where you can't rely on just one tool. You have to use the proper trade and risk management practices. So at this point here, you're getting stopped out. You're taking a small loss, nothing crazy. You've had a good run before that. But at this point, with the cycle stretched to day 80 or so, we know we're in what we call a transition cycle. We know that the market is transitioning from a bull trend to a bear trend at that point. And we come down here and make a deep 81-day cycle low. And at this point here, at 6,000, obviously down, from 20,000, we know now that the market has changed. The makeup has changed, the trend has changed. We are now in a bear market. And then also, when you know that the 4-year cycle is sitting on year 3 up here, you know that we are well overdue for a top. We're well overdue for a bear market decline. And we've seen a parabolic spike to 20,000. And now we're down to, already in February, down to 6,000. You really have to listen to the cues of the market and put any bias you have behind you. And then realize in situations like this that the market has changed. And very few people realize, even in February, very few people realize in April. In fact, very few people realize even all the way out here, to be honest, that the trend was still lower and that the bull market obviously had ended. So now we're into what we call bear market trends, and we're going to flip back here. So now we're kind of at this area here. Okay, the 4-year cycle has peaked, and now the 60-day cycle is oscillating. It's going to start oscillating lower. And what we're looking for now is, if you look at these numbers, okay, 27, 34, 30, 19, these numbers are much smaller than the 54, 48, 61, 38 that we had in the bull market trend. So what's that telling us? It's telling us that the peak now is occurring within a cycle. The peak is occurring earlier, and that makes sense. We're in a downtrend. In the downtrend, you expect the market to be rising for a shorter or fewer amount of days than it is declining. And that's what you have here. Now, you don't have the series of lower lows yet. We've had this huge support line here that held for almost the entire year. But it was pretty obvious that the trend was lower. It was pretty obvious that you should be shorting the top of the Bollinger Bands. So where we were buying in an uptrend, the drops, okay? So you want to buy the dips in an uptrend. And you can see that with the RSI 5 dipping below 30. In a bear market, you want to do what they call, you want to sell the rips. So you may want to buy early on, but be very nimble and take profit very quickly. But you want to be selling what we call the rips. The first touch of the upper Bollinger Bands typically is a sharp move to get there. It happens early in the cycle, but at that point you want to be looking to actually go short. And again, you're going to employ you're going to employ the right risk management tactics. If you're going to get in, you're going to you're obviously going to risk no more than, say, 2% of capital. You're going to find the right place at the right time to short, and you're also going to look first for a reversal. You're not going to just get in because it touched the upper Bollinger Bands. You're going to wait for either a swing high or maybe a dip back below the 10-day moving average, for example. There's a number of strategies you can use. Point being, though, is that in a bear market, you're now looking for opportunities to short the market. Okay, and then you're taking profit on the short towards the bottom in the day 50 to day 60 range. And this occurred now over the last year around 5 or 6 times. And more recently, we broke that support. We've come down into this sort of day 65 area back in December. And this is where, if you remember my 4-year cycle video, this is where we're now looking for the potential for a bear market bottom. It may have occurred from a price standpoint right here in December, but the next cycle low is not due until February the 15th. So as a 4-year cycle low must end with a 60-day cycle because they're intertwined. Okay, so we could draw something out here in February, and then we can also draw something out here in April. So we don't know where the 4-year cycle ends, but because the 4-year cycle has been fairly consistent, we probably can make a safe assumption that the bear market low is going to end in the February low, or already ended with the December low, or in the worst case, if it has stretched out, it's going to end with the April low. Point being that we are in the timing zone for a major 4-year cycle low. Doesn't mean a bull market will resume immediately, but it means that from a price standpoint and certainly from a sentiment standpoint, we're going to start to see that bottoming period occur and the accumulation phase of the next bull market begin. So what could happen from here? Just very quickly, I don't want to predict price at all, but I do believe we are... That wasn't a very good drawing. Excuse me for a second. So I do believe we are still in that declining phase. I believe we topped on day 9 for this 60-day cycle. Again, that makes sense. Left translated, top early and before the midpoint of the cycle. I think we may have a slight pop left in us, and then we move down into this February 15th area where the next cycle low is due, and then we can rally up from that point. But nothing significant. We are still in what I call kind of this crypto winter phase, even though maybe a new 4-year bull market or 4-year cycle, I should say, it still can take a lot of time for it to move higher from a price perspective. It takes time for the accumulation phase to really start to take hold. But you can start to see it climb itself out over time, and then you start to get more awareness in the cycle. So then we can draw something like this, and then we can draw another cycle. So now what he's starting to see, cycle lows begin to make higher highs. And that's really the start of the new 4-year cycle. We just don't know exactly when that occurs and at what point, but we know we are in the right timing band for something like that. So here I've drawn the peak sort of to the right of the midpoint, as we explained earlier in the bull cycle, and right now we're kind of still putting in these left translated cycles. So that covers for you the 60-day cycle and how it relates to the 4-year cycle. I hope you've enjoyed this. I know it's a lot to take in for a lot of you who are just looking at this or being introduced to cycles for the first time. But again, if you like this, tell me that you like it, and I'll work on some more videos along this nature, and also talk about how to trade some of these cycles. And also I'll come out with some videos on some ideas on actual trade setups that you may be able to employ and potentially profit from. So thank you very much again, and I hope you enjoyed this. Take care.